This is a story about a dude named Lane. He moved to the mainland and bought one place to stay. And then one day he went try to rent them out. And then he became one real investor man. Hey guys, Lane with the Simple Passive Cashflow podcast. I recently got a professional pop filter put on my microphone. It was $3 off Amazon. I finally can put away this homemade pop filter that I made with two 8.5 by 11 sheets of paper and a paper towel. Post a picture on the website so you guys can see in case you guys want to make a podcast of your own. This is how I recommend starting a podcast. Things I've been doing recently, I call these cash flow fails. Recently, I tried to do Rover.com, which is a dog walking and dog sitting service. So I've got my dog. I thought he looked pretty bored, so I started sitting other people's dogs. And I only did this twice. The first time it was okay. The second time, this corgi attacked me. Well, attacked my dog first, and then attacked me. And after that experience, I'm not going to do Rover.com anymore. I also got approved for Wag.com, which is kind of another dog walking app. It's a little bit more expensive, so maybe I might still do that one. It seems like people who are not bottom feeding for $25 a day for dog sitting tend to have behaving dogs. I guess again, you get what you pay for. Another thing I've been trying is Airbnb. I've got an extra room in my house. Gotten about 4 or 5 people staying at my place. So far, it's pretty passive. It's a lot better than watching someone's dog, that's for sure. These people, they tend to come and go on their own. I don't have to let them out to use the toilet and they seem to find meals on their own. But I got a bad review this one time from these 2 kids from, Asia. They didn't speak much English. They said that there were some spiders and it wasn't very clean. And I'm like, dude, you guys paid $50. I mean, what do you guys expect? I mean, is this this ain't the Hilton here. They gave me 2 out of 5 stars, which really screws up your online profile on those Airbnb sites because it really means a lot. So I don't think I'll be doing the Airbnb thing anymore. I just wanted to kind of try it out, different ways to build cash flow, but those aren't very passive. People say Uber is a cool way of making money, but that's just a job. I mean, they try and tell themselves that they're self-employed, but you're still working for someone. You're still working for the man. You're still doing a job, trading your time for dollars. In other news, I don't know if you guys have seen my Kickstarter. Well, I guess nobody has seen it. There's only 2 people that donated money to get my Kickstarter off the ground, which was to write a book on this turnkey real estate investing. One of my buddies said that, turnkey real estate investing, what is that, like a 2-page book or something? And I think you guys realize that it's a little bit more than 2 pages. And I'm not good at writing. And that's kind of why I do this podcast format. Because of the lack of interest and my lack of knowledge in writing, I have decided not to do this Kickstarter project, which is a book, but instead turn my attention to creating some sort of a webinar. The goal of this webinar is to go through all these investing fundamentals and how-tos in a linear format where you can kind of start with the basics and move up in intermediate style and advanced stuff in there too. The podcasts are great, but I think that it's a lot of individual topics and it really doesn't hold your hand all the way through the process like this webinar will do. So that's what I'm kind of working on the side. I don't really care for private mentoring. I know some people have been asking, and I guess I would, but the price has to be right. I'm all about passive cash flow, and to be coaching someone for a fee is, again, like trading your time for dollars. And that's something I'm trying to get away from. And I think everybody should be trying to move away from that model in anything you do. Some new news on the lending front. A buddy of mine mentioned that properties 5 through 10 can now be funded with 80% loan to value. Previously, it was 75% loan to value. You can still get the 25% down payment and save a little bit money on the interest rate. But for those of you who are trying to optimize the least amount of money upfront for investment property to keep that cash out of pocket minimized, this is the way to go, is to put down the least possible, which is this 80% loan to value. These Fannie Mae products are having these days. And again, these terms change all the time. And right now the trend is that they're slowly loosening up. So work with your lender on this stuff and make sure you're not working with the big bank down the street because they're just not going to give you the best rates or terms. I wanted to ask you guys for some feedback on these interviews I've been doing. If you guys like the question sets, if there's anything to add, anything to take out. I'm really trying to find people who have escaped the rat race with real estate or some other passive venture. Because I think a lot of us don't really know what we're working towards. I mean, I ask a lot of time, well, what's your goal? What are you trying to accomplish here? You know, some of these flippers and wholesalers will say, well, to get money. And I'm like, well, that's a dumb goal. That's really not going to get you anywhere. So my hope was to interview these successful people. It really doesn't take you that long to get there with real estate. I mean, that's how great real estate is. To start thinking of the end in mind when you're going about doing investments and creating a portfolio. Again, shoot me an email if you guys have any feedback, good or bad. I can take it. The content of today's podcast is going to come from Buck Joffrey's podcast. He interviewed me. He was on the podcast a few podcasts ago. He was the doctor that you guys seem to enjoy listening to. So here's the podcast.
You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everyone. This is the Wealth Formula Podcast with Buck Joffrey. And today we're taking a little turn here, and we've spent the last couple episodes talking to people who've been out there for a while and have gotten a lot of experience. And now I wanted to turn to my friend Lane Kawaka, who's actually a young guy and has had a lot of success in the couple years he's been doing things. He's actually an engineer based in Seattle, and he has been focusing on real estate. So I wanted to get him on as an example of someone who is and has made that step from being a well-paid W-2 wage earner to trying to create multiple streams of income. So welcome, Lane.
Hey, Buck. Good morning.
How are you?
Good.
I should also mention that Lane has his own podcast called SimplePassiveCashflow.com. It's that's the website, and then Simple Passive Cashflow, which you can download on iTunes, which I think is a neat little show, especially the introduction song, Lane. That's really impressive. Well, you're actually singing a song about Lane, but. Anyway, so Lane, let's get down to business. Tell me your story, man. You're from Hawaii, so how did you, go from there to get to the mainland, and you're an engineer. Tell me your story.
Yeah, so I grew up in Hawaii, moved to Seattle for college, went to University of Washington, where I got a BS in industrial engineering. Eventually, I get a master's in civil engineering there too, but pretty linear path up to that point. I went to work at a employer who used my engineering degree to manage other employees in construction. Had to travel a lot with this job. It was actually 100% travel, so I would leave the house on Sunday and I wouldn't get back till Friday evening. So all this time on the road, kind of got old after a while. The good thing was that I got compensated for this. And about that time, it was the 2000, I graduated in 2007, and then the 2008, 2009 economy crash. And it was a pretty good job to have. I didn't get laid off or anything like that. So I was able to save a bunch of money. And I bought my first rental in about 2009.
Well, let's go back to before your actual purchase. Tell me, were you thinking during this time when you were studying engineering, and obviously you're a smart guy, industrial engineering, and at UW is pretty significant academic stuff. Tell me, were you thinking during this period, I need to do something else, or how'd that go?
I was thinking about this the other day, and why did I go into engineering? I don't know. I was programmed at a young age to get a degree that used science and math. I do believe. I don't know why I chose that. I knew that engineering jobs get paid well, and maybe that was the really only thing I was going for. But I really wasn't. There was nothing really that, wow, I wanted to be a doctor to save lives, or be a psychologist to help people. There was really nothing pushing me. There's really, it's just kind of following a path, like I said.
And how about that moment when you said, well, gosh, maybe I should buy a house and, go on my own and well, not on my own entirely, but take that step and invest in real estate. Where did you get that from?
Well, I was always kind of a miser or a cheapskate, as you said, with money after graduating. I was making this money, but, not really going to Starbucks, just saving it. And, I was still following that program. You save your money to buy a primary residence because that they say that's the best investment. And I believe that there was kind of an escalator. Once you buy that first home, you kind of ride that escalator of wealth building, which I finally found later that wasn't quite true.
Right. And did you have what was an aha moment or anything where you said, okay, now I'm going to buy a house?
I just was saving money, and I really didn't know what to do with it. I mean, I did a Roth IRA, I think when I was like 13 years old, so I was kind of into stocks. I went through a couple year phase where I was trying all the swing trades on the stock market. That got to be a little stressful. I was mostly doing mutual funds at the time, and people always just told me you need to buy real estate. That's all I knew about it. I was pretty unsophisticated at that time.
So you're unsophisticated. You say, gosh, I think I need to buy some real estate because maybe that'll help me, to create another stream of income. How did you go about that? Because that sounds like, for somebody who's unsophisticated and who's never done it before, that sounds like kind of a big deal, right?
Right. I mean, I just saved the down payment. The 20%, 25% is what people said to do. So that's what I did. I went to a house that I liked. Somebody was sitting in there, the guy selling the house, and I said, hey, can you help me find a house? And of course, these real estate agents, they're willing to help. They definitely get paid on the back end, and we were off and running.
And that was right there in Seattle?
That's correct.
So you obviously, so there's somebody sitting in the house, you want to buy a house. Now, how do you go figure out, I can rent this house for so much money, et cetera? I mean, obviously you could have bought a house and then realized you're not going to get enough rent to pay it off. So that's not a great investment, right? So how did you sort of break through that question, probably that anybody really is going to have who's doing this for the first time?
All right. I got lucky, quite frankly. I bought it at the right time. It was the down part of the market in 2009. I bought it for about $360,000. At that time, it would have rented for about $2,200. So I think the mortgage payment with 20% down would have been about $1,600, $1,700. So there was some spread within the rents and what the mortgage was. But I didn't know anything about the 50% rule, anything about expenses.
Tell us about the 50% rule. What is that?
When you're underwriting your deals, they say to put 50% of your rents to expenses such as your monthly maintenance, your property management, your capital expenditures, and just things will happen. So, for example, that $2,200 of rent that property would have brought in, if you don't know anything about the property and you're just doing a quick back of the envelope calculation, they say cut that in half, and that's probably going to be your take home at the end of the day. So 2,200 divided by 2, that'd be 1,100. And just in that little example, my mortgage would have been 1,600. That property would have cash flowed negative, right, just with that conservative underwriting.
So you got lucky on your first one, which is sometimes good and sometimes bad. I mean, it's good in that, it encouraged you to keep going. And a lot of times, people will have an experience where they buy a house and things don't go well, and they're like, I'm losing money. And instead of trying it again, they'll just quit, right? So you got lucky in that regard. And then obviously you started seeing some cash flow, and you thought, well, this is interesting, right? So what'd you do next?
Well, then I started reading all this Rich Dad Poor Dad book, and I was like, wow.
That's right. Well, Robert Kiyosaki has inspired a lot of people. I mean, obviously I'm one of them, and you're one of them as well. And so what was it that inspired you about it? was there a specific idea that you took away from that kind of carried you to the rest of your journey?
He just really showed that, there's really two kinds of people out there. There's the folks that are kind of living the employee mindset. And then there's these other people who have kind of seen the matrix and, living with all this. The goal is trying to build up your passive income so you can leave the rat race.
Right. And you then went on to buy a bunch of different houses. And how many houses do you have now?
I have 11 now.
11. And you talk on your show a lot about this concept of buying turnkey homes. And I know you don't want to be pigeonholed as the turnkey guy, but tell us what exactly that is. How does that work?
I guess if I were to continue in my story, I bought another property in Seattle. But then around 2012, all the prices went up. And because I was more sophisticated at that time, I quickly realized that a lot of the cash flow just wasn't there. I'd be buying properties that are under the 1% rent to value ratio. And what that is, that's a quick and dirty indicator of your ability to cash flow. So if you were to buy a property for $100,000, 1% of that is $1,000. And that's what you should be getting in rent. So if you're under 1%, it's you're probably not getting cash flow. If it's above 1%, then you should probably take a look at it as a potential purchase. So what I started to realize in Seattle, with all this Microsoft money and the tech money, these people were just, wanting to put their money somewhere. So they were just bidding up all these properties. There was no cash flow. And then I just kind of saw all this out of state markets that you're finding these 1% deals or even 1.5% deals all over the place. And my goal was to replace my income. And to do that, you need cash flow. Now, Seattle has great appreciation potential similar to California, but that was not my goal. My goal was not for appreciation, which I kind of call gambling. It was, again, for cash flow.
So are you there yet? Have you replaced your income?
The problem with these turnkey rentals, other than the fact that the margins of cash flow are getting narrower and narrower every day, is that you've got to buy a whole bunch of these things to hit your number. You probably need for my number is about $5,000 to $8,000 is when I need to be able to quit my job to be able to live passively off my rental property income. And to do that, I would need about 20 to 30 properties.
Really? 20 to 30 properties just to hit $5,000 to $8,000, huh?
That's right.
So sort of had another aha moment, I can tell. So what are you going to refocus on something? What's your plan now? Because if that's a lot of houses to go one at a time, right?
That's right. I mean, even with 11, it is pretty easy. I mean, I managed the manager, but unfortunately, I'll run into a eviction once a quarter, and a couple of things will break every month. But you just imagine, if I have 30 of these homes, now triple those kinds of instances. And now it's becoming quite the passive job.
Right. That's the problem with that I've always had, and I've never really gone the route of owning individual homes. Although, I don't think it's a bad idea, particularly if you don't have the money to get into apartment buildings, etc. But, one of the challenges you have there in single-family homes is, when you look at an apartment building, one of the things you talk about is vacancy levels, right? You don't want a lot of vacancy. The problem, so you might look at I have a 20-unit building right now that, a couple people moved out. Well, okay, that's fine. I mean, I still have 90% occupied, right? In houses, you either have 100% occupied or 100% vacant. And so that is a little bit of a challenge there in that arena. So are you thinking apartment buildings?
Sure am. I mean, I guess it's I've gone through quite a transition this year. Earlier this year I went to a workshop where there were about 500 investors, and they were all for these turnkey rentals, picking up 5, most of them had about about the average. And then I meet up with you at the syndication seminar with all these higher level investors, and everybody's, teasing their little single family homes, thinking that it definitely was not the way to go. And the apartments and much larger commercial deals, they're just more scalable, more sophisticated. And so that's the path I'm heading down now.
I think you hit on a good point, Lane, and this is something that, I talk about on this show sometimes, is that, the idea of smaller and, simpler is actually pretty deceptive. In my experience, whether that be, buying real estate or running businesses or potentially looking at acquiring businesses, the bigger the business, the bigger the property, the easier it is. And the reason for that is that usually what it comes down to is that you have a lot more variables in those properties, but you have scale so that you can manage them with a manager. And then the other thing is, when you're actually trying to acquire something, it's really hard to fudge numbers, right? And so if you have let's just say, for example, you're buying a duplex or a 3-unit even, which is, it's fine, do it. It's still a great investment. But sometimes it's a little bit harder to understand, just based off of those 3 units, whether something was, when you look at those financials, whether, it was a streak of good luck that the owner had and kept these places full for the last couple of years, or if that's just where it's at in that building. I actually bought a building. It's just the nightmare scenario that you hear about. One time, it was actually pretty. It was not huge, but it was like 12, 13 units. And it turned out, it was small enough so that this guy who sold it to me was a property manager in the area, and this is sort of a D-class area. So that I wouldn't recommend that either. But he was totally cooking the books. Right, so he had other people in other buildings that he was moving in, and and he was essentially using money for other building rent and putting it into this building to show the financials better on this because he wanted to get rid of it. And I couldn't prove it, so I couldn't take him to court or anything. But at the end of the day, it was pretty clear that that's what was going on. And I ended up selling that building for a substantial loss. Now, if you're dealing with a 100-unit building, okay, it's really hard to do that. It's really, really hard to do that because you can't fake your tenants. 100 units, you can't do that. You're filing your taxes, etc. And it's hard to move people around when you have 100 units. You have property managers that you actually have to have as full-time people there who are employees of the building. So that makes it a lot harder to fudge numbers. Does that make sense?
Yeah, and I'll also add the reason that to go to these larger properties is not only your property management, but all the vendors that come through your property. You're not getting, side the guy who does the plumbing and then the handyman on the side, but you get this, this very reputable company who signs like a $20,000-$50,000 contract with you to go out and do 150 of your units. I mean, just the level of sophistication and how these guys just don't screw around with this stuff.
Yeah, the other thing is, and I think one of the most important parts of the commercial grade real estate versus residential is how you value that property. So if you buy a home and you're trying to get a loan on it or you're trying to refinance, nobody cares about how much rent you're getting for that home. They look at it like any other house in the neighborhood and they appraise it for that amount. Okay? So that's a tricky thing, right? You don't have any control over the value of your property. Whereas in an apartment building, now you're talking about a commercial, anything really, it's just not a huge apartment building, but anything over 4 units, so 5 units above, the way that the appraisal works is not by looking at every other, little place in town and say, well, that one went for that one went for that. It's based on how much rent that property is generating. And then something called a capitalization rate, which is essentially for a given area, for a given rent, how much is a typical return on investment. So it becomes a much more mathematical game, right? And there's not as much speculation. Obviously, there's always a tiny bit of speculation there no matter what. But that is inherently less risky, because if you raise rents, your property value goes up. That's how it works. You're forcing equity versus hoping for equity.
Right. And the example I always like to think of is, say you bought an apartment complex and there's 5 parking spaces outside, and you want to start renting those out as reserve parking spaces for $20 a month. So $20 times 5 parking spaces, you just created $100 of revenue a month. Now let's just say that's $1,000 a year of extra revenue, and then you divide that by the cap rate. Let's say it's a 10 cap rate. I mean, you just created about $10,000 of equity right there. If I did the math right.
Well, you're the engineer, so I'm not going to check up on your math.
Divide it by the 0.10, and that's how much equity you've created just by doing something simple like renting out 5 parking spaces for $20.
Right. So, I mean, at the end of the day, I think one of the lessons that I've learned in that regard is, try to push the limits on how big. Just because you've never been in real estate before doesn't mean you have to start with a house. I didn't start with a house. My first building was, I don't remember, it was over 10 units, but and frankly, for me right now, I wouldn't touch anything less than 20 units because of what I've learned along the way. But so let's go back to your story a little bit. Lane, you're a young guy. I mean, you're only how many years out of college? You're not even 30 yet, right?
I'm 30 now.
Oh, okay. You are a 30-year-old man now.
Oh, man, now.
What advice do you have for people who, you represent, people who listen to this program, which are, highly educated W-2 wage earners. Okay, not everybody's, coming out of the gate thinking that they, that they can invest in real estate, that they can do things other than their own job and, throw money into a 401k. Can they do this? And, and obviously they can, but I'd like it from your perspective, obviously, as somebody who's still in that transition. Give us some words of wisdom.
So I run a meetup with other professionals similar to myself, and I think the biggest mistake I see is a lot of these people, they don't differentiate between investing in active or passive roles. Most times the shiny object or the person tugging at their coattail is that wholesaler or rehabber that needs private money. So a lot of these professionals such as myself kind of get into the flip, partnering on flipping deals, and that's a job. And I definitely don't recommend that for people who have a much higher billable rate than I do. I mean, I really like the turnkey model or passively investing in syndications.
Right. So you don't even have to do this stuff yourself necessarily, but there are ways to get involved. When you're talking about syndications, just so there's some clarity on that, it's a private offering. They'll have somebody, like me or Lane or whoever who's got some experience in real estate, and we'll say, okay, well, this is a building that is, $7 or $8 million building. Well, I'm not going to pay for it myself, and it's not safe for any one individual to go into this. So let's recruit money and go into this together. And then you as a limited partner with this. So Lane and I, in this case, would be a sponsor, and we would do sort of the legwork behind it, the due diligence, put all the property management in place, get a plan for the building, and then there's the limited partners, or people who invest in the offering. It's a private offering, and then they just collect passive income. So that is another way to do this, and certainly we'll have plenty of people on the show who are doing various offerings and that sort of thing. But yeah, so that's another option. Why aren't you in the stock market?
Well, the risk reward. I mean, in the stock market, it's only about 8 to 10% if you're in one of those mutual funds. And then I see it as a sort of a little Ponzi scheme. I mean, I don't know how the stocks are evaluated. It's also, there's all the numbers on their balance sheet, which who knows what that is. But it's also dictated by the street's expectations, and I don't know what that is. And the way I always explain is that it's a two variable equation. You just can't solve those kinds of things.
Yeah, I was being sort of tongue in cheek. I mean, on this show, I'm never a big fan of the stock market, and if it were indeed 8 to 10% per year, like you just said, I would be in there for sure. But it is not. In fact, if you go back to the stock market has been sideways for about 2 years now. There are record highs right now, but they're just a little bit above where they were 2 years ago. And those are really just the blue chips too on top of that. So, there's I mentioned this in one of my recent podcasts, listening to Robert Kiyosaki's podcast on he was interviewing Harry S. Dent, the economist, and was talking about how these valuations and decreases in earnings and profitability, really the projection right now is that if you get in the stock market right now and you're not currently in it, that you'll probably be negative in the next 8 years. So that's a far cry from 8 to 10%. But I think what I think the value of what you're doing and what a lot of real estate investors are doing is that there's generally a very predictable income. Of course, nothing's 100%, right? But at least you understand that you own something, you own a business, and any apartment building, any house that you're collecting rent for is a business. It has an activity, which is that people need to live there. They pay a price for that. There are expenses, and whatever comes up, from that, whatever's left is yours to keep. And that's a very, very simple concept. Whereas in the stock market, we're talking about, crazy valuations. You have crazy valuations for companies that are making no money. An episode where we had Dr. Eric Tate on, he was talking about how in business school, this was during the whole Enron crisis, that Enron's stock was sky high. It was being recommended by just about every wealth advisor. And in his business class, they went through the financials and realized that they hadn't made a profit in 3 years. Now, if you have a house, or if you have, I should say, an apartment building that hasn't made a profit in 3 years, no one's gonna buy that from you for a crazy amount of money. And that's what people are doing in the stock market. They just don't realize it. So what we're doing and what we're advocating is to invest and try to understand what you're investing in. And when you invest in real things, that's what you can do.
That's right. And it just comes down to numbers. I mean, rate of return. With these kind of turnkey rentals, I mean, I typically get 25 to 35% a year. I mean, it's just night and day. 25, 35%, or do you want 8 to 10%? They're not easy, but like my website, Simple Passive Cashflow, it's simple.
Are you paying cash for those, or are you leveraging?
I leverage. I'm an advocate for leverage.
Yeah, absolutely. Well, good. Lane, it was great talking to you. I mean, I think, the point of this show, obviously you're a young guy and you are on your journey. You're you're a hardworking professional, smart guy, and you've seen the light, and you're trying to create multiple streams of income, and you're showing that it can indeed be done. And I predict, because you're 30 years old, right, and you're doing this at just the right time. You've got you got no kids, you've got no responsibilities, your overhead is low. Before your own overhead starts to increase and you have an expensive house and kids and so on, now is the time to go for the jugular. And so I congratulate you, and I really, really anticipate that in the next 10 years you're going to blow it out of the water. So congratulations.
Yeah, thanks, Buck.
Thanks for being on the show, and we'll see you next time on the Wealth Formula Podcast.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.
This website offers very general information concerning real estate for investment purposes. Every investor's situation is unique. Always seek the services of licensed third-party appraisers and inspectors to verify the value and condition of any property you intend to purchase. Use the services of professional title and escrow companies and licensed tax, investment, and or legal advisor before relying on any information contained herein. Information is not guaranteed, as in every investment there is risk. The content found here is just my opinion, and things change, and I reserve the right to change my mind. Above all else, do your own analysis and think for yourself, because in the end, you are the only person who is going to look out for your best interests.